Good evening, everyone. Time for another silver update. This is the daily chart of gold provided by netdania.com. You can click on the link below. I've drawn in the primary trend channel. You can see that channel starts all the way back in the fall of 2008, which was the bottom, around $700. We've gone to the top and then to the bottom, top and bottom, middling, and then broke out of the trend channel. Was looking like we're going to establish a new level of rise, and then of course we had the big smackdown in September. You'll notice that the May smackdown, which occurred in silver, really isn't even visible on the gold chart. So that's more evidence of my contention that it was a coordinated assault specifically against silver. Of course, my contention that silver is the key to the financial system, and that goes back to the collapse of Bear Stearns, the assumption of their silver shorts by JP Morgan, and the ongoing machinations. But we look at this chart, you can see the trend channel is still very strong. Now we're just getting into a midland area here, and we could either go up or down to test this channel. You can see we briefly dipped outside of it and came right back up. And the other thing to note is that the MACD does appear to be rounding and heading down. I've seen from the silver chart, I kind of expected a sell-off, but that hasn't occurred. So we may get a correction down to this trend channel, or then again we may correct up. The other thing you want to note on this chart, let's go in just a little bit here on the scale. When we look at the price action here, if you remember, the financial news media, of course, is always in a state of delight whenever we have a violent sell-off in gold such as this. And of course, you see all of the articles coming out about gold is in a bubble. You see all of the Gartmans and the Kramers and every page shill and shyster out there coming out and screaming that gold is a bubble, it's reached its top, and it's done for. Well, the thing to note here that's of interest is that at the price we're at here, roughly 1730 or say 1750, you really only have about a 2-month period or so here back in the late summer and early fall, maybe 2 to 3 months, and then maybe a month or two here. So really only maybe 3 or 4 months in the history of the price of gold that it's traded any higher than it is right now. So for all intents and purposes, the gold bull is already resumed. We really just need to get a new high above this trend line, and we'll probably be off to the races. So we may get a test of the lower trend channel and then blast up, or we may just go straight up from here. We'll just have to wait and see. Now, as I pointed out, the action in silver was so much more dramatic and violent, and you can see that in the May smackdown. Obviously, the run-up was also tremendous, so the correction was really only a third. This smackdown that came in September was actually more dramatic, percentage-wise and dollar-wise. Percentage-wise, of course, because it came from a lower price, but it was also a larger move from top to bottom. So this was a huge, huge smackdown, and we covered before how the suspicious volumes on the SLV exactly coincided with that. You can see also we have this rolling over effect in the MACD in silver. So there is a potential that we'll get some correction or backing and filling, and that's obviously an opportunity for the stackers. Now, the big story that came out this afternoon was broken on Zero Hedge, and that is that the CME came out and cut the margin requirements on the metals. Now, a lot of people have speculated as to why that would be the case, and of course, if you go down here and read the snide comments on Zero Hedge, some of the people nailed it on the head, and that's what I believe as well, that probably the CME is seeing the writing on the wall and recognizing that their they're on a quick road to irrelevancy, and the MF Global thing was a huge blow to them, and perhaps this is an attempt to recover. Of course, they're simply going to explain it as being that the volatility in silver has decreased to the point that it's safer to reduce those. So that's obviously going to be the party line. But I wanted to bring out the chart that I use. I composed this chart when we had the margin increases back in May. We had back-to-back. Well, let's go look at them. We had back-to-back margin increases April 29th, May 2nd, May 4th, May 5th, and May 9th. So we had 5 back-to-back margin increases that took us from about 9,500 to 16,000. So nearly double if we go from that March increase. Now, the current margin changes that we did, you can see in the PDF here that Tyler has posted. You have, if you remember, you have your 2 different types of margin. You have your speculative margins, and then you have your hedge and member margins. Traditionally, let's get down to silver. Traditionally, your hedge margins are always going to be lower than your speculative margin. The reason being that the margin requirement, the purpose of having a margin requirement is that you post a certain percentage of the cost of the contract, and if it moves against you, then that's where you get your maintenance margin, and if you reach this level, then you have to pony up some more money. But you have this discrepancy between the speculative margin. You can see here it was 24,000. It's been lowered to 26,000, and then you have, of course, initial versus maintenance. Those are the 2 types you have. So the initial has dropped from 24,000 to 21,000, and the maintenance has dropped from 18,500 to 16,000. And that's on the spec. So now the reason that they will give you is that the hedge or member, the reason why they would have a lower margin is because to be a hedger, you have to be a producer. In other words, you're a person who actually generates the commodity, whether that's a corn, wheat, or whatever the commodity is that you're a hedger of. You're expected to be the producer. Now, what's so strange about the situation with bullion is that your hedgers and members, the bullion banks, these people, and probably JP Morgan and Scotia Makata and all the rest of them, these people don't produce any gold or silver. They're just shorts, and probably naked shorts. But they get this lower margin because they are considered to be hedgers, while the speculators are these speculative buyers. So those people have to pay more. But you can see that the margin changed from 18,500, this is for the maintenance, down to 16. So if we go back to the chart, I actually missed one. I just put in a random date here. I don't know when it went. The last one I had was the 16,000 from May. And the chart there that we just looked at, the PDF that we looked at on Zero Hedge, showed this, that we actually went down from 18.5 to 16. So there was a point there where I missed it, and I'm not sure when that occurred. But just for informational purposes, what I did here is I set the price at the bottom that we hit when we had the September Smackdown. We briefly touched down to $26, and at that time the margin was 18.5. So the way these columns work is that you have your date, you have the margin requirement, you have the current price of silver, and then you multiply times 5,000 ounces to get the value of the contract. And then you have a percentage, which is the percentage of the value of the contract that margin requires. So you can see back in the beginning of the bull market back in 2004, when silver was $5.60, you only had to put up $1,500 to carry a 5,000 ounce contract. that's worth $28,000. So you only had to put up about 5% of the money to control 5,000 ounces. You only had to put up $1,500 to control 5,000 ounces of silver. Now, as the price began to rise, and as I pointed out before, you would expect that it's only normal that they should raise those margins as the price rises to keep the percentage the same. And that's what you can see here. Even though the price of silver went from 5 to 6 to 7 to 8 to 9, 12, 13, 13, etc., you can see that the percentage stayed pretty steady here. You've got 5%, 6%. We spiked to 8%, back to 6%, and then we're down around 4%. We get some increases where it's 7 and then 5 and 5. So as the price is rising, they're raising the margin requirements to keep that percentage steady. So we had some highs of 8 and things like that, but nothing really dramatic during this long bull market until we get to the lows of 2008. And if you remember, we had the Bear Stearns crash, basically, where silver came from 21 in March of 2008 and fell all the way down to $9 in October of the same year. We did not have any margin decreases. In fact, you can see during that time frame, they continued to raise. Well, they had this one downtick here. But then in September, as the price is falling, they continued to raise margin requirements so that we got up to this number here, 14.2%. That was the bottom. And it actually took 14.2% of the value of the silver contract to carry the full contract. And that was the bottom. And then as the price began to rise, we had the same effect here. We're all the way back down to 5%. They did some raising and lowering, etc. And then we get all the way up to, here's a low of 3% when the price hit $48. That was right before the massive increases in margin. So you can see with the margin increases in the May SmackDown, we went from 3.9% to 5% to 6% to 7.3% to 9%. And then somewhere, I don't know when it was, I just put in this $26. If we were at $18,526, that would have been a 14.2% amount of value. And what's so interesting about that is that 14.2% is exactly the price percentage that we had back in October of 2008. And that marked the bottom. So we are now to 9% with this recent change if we go based on $34 silver. And that is very interesting because when we get back to the silver chart, we can see that if we pull out here and get the weekly, we can see that this point right here marks the point when we were at 14%. We drop a trend line here and we get to right here, and that is the next time we're at 14%. So is this a bottom? Pretty clearly it is. Is this a bottom? And are we going to go to 5%? So if we went to 5% right now as we stand, which is really the norm, the price needs to double from here to $52. If we do double from here to $52, we probably will be off to the races because $52 will break this resistance point, and probably the general public will pile in, and it will be on to triple digits at that point. So very interesting that the CME has decided to come out and lower margin requirements on the precious metals. They are going to say that it is a decrease in volatility, and that's why they did it. I am going to say that they are probably losing a lot of business as people like Ann Barnhart and others take their business elsewhere because the CME can't be trusted. Last of all, I wanted to take you over to the blog. I had the privilege of doing an interview today with Kerry Lutz, and he's really a professional. You can go and listen to that interview on my blog, or you can go over to Kerry's Financial Survival Network and listen to the interview. It was a great interview for me because he's very professional, and I really appreciate having the opportunity to do that interview. Hopefully we'll be able to do them in the future. So if you get a chance, go ahead and listen to that. And I got a chance to explain the idea behind Silver for the People and what it's about. Hopefully in the future we can dig a lot deeper into that. And just back to the charts. The silver chart is still, in my opinion, very bullish. We have this unique double bottom formation here that we formed that looks like it's going to be the bottom. We have a fairly strong MACD crossover, and it looks like we're going to try to get up to that zero line. If we cross through that zero line with some strength, we could very easily make the run up towards that $52 price. And we'll talk to you next time.